Nancy, I'll begin with you. Good morning again. We've seen some pressure on the futures right now. Again, we're off of our lows, but still some pressure on the futures after the president said auto tariffs, chips tariffs, they may be on the table, maybe even adding pharma tariffs. Does that shake up the thesis that we were, at least briefly, at a tradable bottom?
Well, we think we're still in the process of making the tradable bottom. Certainly, investors got very cautious, very pessimistic. We know there are a lot of concerns about growth and certainly lots and lots of concerns on the tariff front. What we're seeing below all the announcements and speculation du jour, though, is a pattern that looks like it will be more negotiation and working with our trading partners, working with the countries that we're targeting to come up with solutions that benefit both sides. So we think that we're seeing the natural evolution of the market as the risk premium goes up somewhat. The market multiple comes down as a result, and that lays the stage for earnings growth to start to shine through. And those companies that are growing faster than expected, selling at reasonable multiples, can do very well in this environment, even if the overall market averages remain volatile.
Patrick, same question for you. Important to note, the idea of some tariff relief and more targeted tariffs was one reason for the rally. I think it's fair to say the ISM report, better than expected, was also another factor. I don't know what the percentages are, but again, same question for you. The idea of a tradable bottom, that we were briefly there, has that been changed in your mind? Do you think there's more pain to come now that we have more tariff uncertainty?
I just think the uncertainty is going to continue. It's day to day, week to week. And also, we saw the S&P March flash manufacturing PMI miss slightly. And while Europe is stimulating, fiscally, and I think that that's just going to push European yields higher. It's going to push the euro higher. I think, Europeans can continue to invest or begin to invest more in their backyard. And so I think that's going to weigh on markets for some time. I agree with Nancy that it's trying to find a bottom. I just think this is going to be a little bit more longstanding. And the last piece of information is the Canadian PM Carney. He's called for a snap election, and he's basing, this move to sort of oppose Trump, be the opposition to Trump. So I don't see the headlines abating, particularly with that trading partner in the near future.
I want to also just talk about some of the recent volatility that leads people to try to find this tradable bottom. Morgan Stanley CIO Mike Wilson on our air yesterday. I want to get your take from both of you, what he had to say about what's really causing this market volatility.
Everybody's talking about tariffs right now, but the reason the markets are lower over the course of the last 3 or 4 months has nothing to do with tariffs. It's mostly to do with the fact that earnings revisions have rolled over. The Fed stopped cutting rates. You had stricter enforcement on immigration. You have DOGE, which all those things are growth negative.
Patrick, I'm going to give you the first swipe at it. What do you make of what Mike Wilson had to say about the volatility and the fact that he believes it's not actually tariffs?
Well, to say that tariffs aren't a component, the market's moving on a daily basis based on tariffs. So I think tariffs have something to do with it, but it's also DOGE and it's uncertainty, with some of these administrative policies. So I think it all has an impact on it. And higher volatility, as Nancy said, leads to lower multiples. And I just don't see, multiple expansion on the horizon anytime soon.
Nancy, same question. Important to note, small caps had a big day yesterday, rising more than 2%. What's your take on what Mike Wilson had to say and just overall the impact of tariffs on the small cap space? I know is your wheelhouse and the broader markets as well.
Sure. So I'll take the first question on Mike Wilson first. And I would agree. Tariffs are a part of it. It is not just tariffs. There's a lot of uncertainty right now. There are a lot of things to worry about. Now, we all know markets love to climb a wall of worry, and so worries are good. But the risk from DOGE, from lower immigration, from tariffs, et cetera, are causing this growth scare that we're seeing right now. I saw earlier on the program, 60% of business people forecasting a recession in the second half of this year. Now, we've seen this before. The evidence today does not support a recession coming. And so, again, that gives the opportunity for those companies where they are selling at reasonable multiples, where those growth expectations are still there, where they have some wind at their back in terms of growth drivers, to do very well in this environment. The other factor, though, and this gets to your small cap question, that we think we're seeing right now is a bit of a regime change away from just a very select group of anointed winners in the market to a much broader market environment. That's good for the S&P unweighted index. That's good for the Russell 2000 and the Russell mid-cap indices. That's also good for international stocks.
All right, so you're seeing things be pretty good overall when it comes to that area. While we're talking about what's good, Nancy, let's go to you first. Can you give us one of your picks for today and just very briefly tell us why?
Sure. I'll talk about Sterling Infrastructure. It's an infrastructure play. Again, I talked about we want to go where the money's coming in. We want to go where there's wind at the back. This infrastructure rebuilding of America, whether it's power grids, whether it's data centers, whether it's all kinds of electrification, you need to build the facilities to do that. Sterling is a Southwest-based company, does both roads and bridges, as well as all of the exciting data center work, selling at a less than a market multiple at about 16 times earnings.
Patrick, last word, your pick?
Franco-Nevada. I've owned gold now for the last few years. It's a gold royalty company. You take, being a royalty company, you take the cost inflation out of it because it's an asset light, labor light business. And I think owning gold in this environment makes a lot of sense given the uncertainties that we've been talking about and, uncertainties with the dollar as well.